When most people think about retirement success, they often think about retirement returns. They think about the person with a better portfolio performance wins. But that's not actually how retirement works, because two retirees can earn the exact same return, take the exact same market risk, and still have dramatically different outcomes. One ends up paying more in taxes, triggering higher Medicare premiums, taking withdrawals in the wrong order, and putting more pressure on their portfolio. The other keeps more of what they earned, creates more flexibility, and often ends up with far more spendable income over time. Same market, same returns, very different result. The difference is what I call after-tax alpha. And in this video, I'm going to show you where after-tax alpha actually comes from, why it matters so much in retirement, and why one of the biggest opportunities often shows up in a very specific window, right after you stop working. If we haven't met before, my name is Dustin Rudolph, owner and president of Legacy Ascent Wealth, where we help people coordinate retirement income, taxes, investments, Social Security, and legacy planning so that all the pieces work together. And this is an important topic because a lot of people still think the value of retirement planning comes from mostly picking stocks and investments. Now, investments matter, asset allocation matters, cost matters, behavior matters, all of it matters. But for many retirees, especially those who've done a good job building wealth already, the biggest opportunity is not necessarily squeezing out another 0.5% of return. It's making sure the returns they do earn translate into the most efficient after-tax income possible. That's a different conversation. So let's break this down. When people hear the word alpha, they usually think about outperforming a benchmark, beating the market, finding better investments. But in retirement, there's another form of alpha that matters even more in the real world. It's not just about what your portfolio earns, it's what you actually get to keep and what you get to spend. After taxes, Medicare premiums, withdrawal decisions, and income coordination, that's after-tax alpha. In other words, long-term wealth is not determined only by pre-tax returns, it's determined by how efficiently those returns are converted into usable retirement income. That's the game. And this is why two people with similar portfolios can have very different retirement experiences. One has a pile of money and the other has a coordinated plan. Those are not the same thing. Let me show you exactly how two families with identical returns end up in completely different places. A lot of portfolios are built as if investment performance is the entire answer, but investment returns are only one input. Let's say two families earn the same average return over retirement. Family A has no coordinated tax strategy. They claim Social Security without really analyzing the trade-offs. They wait until RMDs force larger taxable distributions. They take withdrawals from whatever accounts seem easiest at the time. They accidentally cross IRMA thresholds and increase their Medicare premiums. And because decisions are made one at a time instead of together, they create tax drag almost every step of the way. Family B earns the same return, but they intentionally manage tax brackets in lower income years. They think through Roth conversions. They coordinate portfolio withdrawals with Social Security timing, and they structure which accounts to spend from and when. They pay attention to Medicare thresholds. They think about survivor ratios and the widow's exposure. Same return, different system. In over 20 or 30 years, that can create a huge gap in spendable lifetime income. That's why I say a good plan is not just about growing wealth, it's about converting wealth into income efficiently. So where does the alpha actually come from? Let's walk through a couple of the drivers. The first one is tax bracket management. Not surprisingly, not all tax years are created equal. Some years give you much more room to take income at favorable rates than in other years. If someone retires and their income temporarily drops before Social Security and RMDs kick in, that can create an opportunity to do Roth conversions at lower rates than they'll face later. And that matters because if you can move money strategically from tax-deferred accounts to Roth accounts during the right years, you may reduce future required distributions, reduce future tax pressure, and create more tax flexibility later. And that is real value. The second driver, income sequencing. Where does income come from first? Consulting income, taxable assets, IRA withdrawals, Social Security. This matters more than many people realize because the timing and order of income sources affects your tax return, your Medicare premiums, and how much pressure gets placed in the portfolio. A lot of people take income in whatever way feels natural, but retirement planning is often about taking income in the way that is most efficient. Thirdly, Social Security. Social Security is not just a filing decision. It affects lifetime income, it affects survivor protection, and it affects how much you need to withdraw from your portfolio in the early years. For married couples especially, the claiming decision can have ripple effects for decades. So when people treat Social Security as a standalone choice instead of a coordinated planning decision, they often miss a large part of the value. Now, the next three, these are the ones that surprise people the most, especially number 5. Number 4, asset location. This is another one that often gets overlooked. It's not just what you own, it's where you own it. If growth assets are placed efficiently and income-producing assets are positioned thoughtfully across Roth, taxable, and tax-deferred accounts, you can reduce tax drag over time. It's not flashy, but it matters. Number 5, healthcare and IRMA planning. And this one surprises people. A retiree can make what seems like a reasonable income decision and then later realize and increase their Medicare premiums. And that's because Medicare IRMA surcharges are based on income thresholds. So if income is not coordinated thoughtfully, you can create extra costs that people often don't see coming. And once you stack that on top of taxes, it adds up fast. Driver number 6, your withdrawal strategy. Which account should you take from first? Taxable, traditional IRA, Roth IRA? The answer for everyone is different. It depends on what stage of retirement, tax brackets, future RMDs, Social Security timing, and legacy goals. A lazy withdrawal strategy can cost you real money. A coordinated withdrawal strategy can improve your portfolio longevity and tax efficiency at the same time. Driver number 7, consulting income structure. For people transitioning from W-2 income into consulting or self-employment, there may be new planning opportunities. Retirement contributions may look different. Deduction opportunities may look different. Income timing may become more flexible, and that flexibility can create planning opportunities that didn't exist before. So when you look at all these together, you start to realize something. After-tax alpha does not come from one magic move. It comes from coordinating many good decisions intentionally. If you're finding this useful, hit the subscribe button. We put out new videos every week on retirement income planning, tax strategy, and making all the pieces work together. Now let me get into what I think is one of the most important concepts in all of retirement planning. This is what I call the 10-year opportunity window. It's often the period right after someone leaves full-time work, but before Social Security and required minimum distributions fully kick in. Why is this so important? Because flexibility is often at its highest. Your earned income drops, but some of the future income streams that create tax pressure haven't started yet. That means the years right after retirement can become some of the most powerful planning years of your financial life. This is often the window where you may be able to do strategic Roth conversions, decide when Social Security should begin, manage future tax brackets, reduce future RMD pressure, control how much income shows up on the tax return, pay attention to the Medicare thresholds, and sequence withdrawals in a more intentional way. Then what happens later? Social Security starts, RMD starts, and flexibility goes down. Income becomes more predetermined. That's why I tell people the biggest planning opportunity is not always when you're at peak earnings. It's often the period right after those peak earnings stop. Handled intentionally, that window can significantly improve lifetime after-tax income. Ignored, it closes quietly and never comes back. Let me make this practical. Let's say someone retires at 62. They're not taking Social Security yet. RMDs are years away. Their W-2 income just stopped. On paper, they may look at that and think, Great, my income is lower. But from a planning perspective, this can be one of the most valuable windows that they'll ever have. Because if they do nothing, those IRA balances keep growing. Then Social Security starts. Then later RMDs begin, and now the same person who had flexibility before may suddenly find themselves with higher taxable income, less control, more Medicare premium exposure, and fewer planning levers. But if instead they use those early retirement years intentionally, they may choose to fill lower tax brackets with Roth conversions. They may delay Social Security to increase that guaranteed income stream. They may harvest capital gains at favorable rates, and they may set up a withdrawal sequence that gives them more control for the next 2 or 3 decades. That is the difference between having a pile of money and having a plan. So here's what I'd leave you with. After-tax alpha is not about finding a magic investment. It's not about beating a benchmark. It's about making sure the wealth that you built gets converted into the most efficient retirement income possible. And for many people, the single biggest opportunity to do that shows up in a window that doesn't last forever. If you're approaching retirement, or if you're already in one of those early years, this is the time to be intentional about it. If this was helpful, subscribe to the channel. We talk about this stuff every week. And if you'd like to see how this kind of planning looks like for your specific situation, you can schedule a consultation with our team. The link is in the description. Thank you for watching, and I'll see you next time.